older, we have to remove our glasses. Right, a very good afternoon, Sri, Dr. Sri, Dr. Distinguished guests, members of MIER, board members of MIER and MIER, Dr. Sheikh, CEO of MIER, and ladies and gentlemen. I must say that it is indeed a great pleasure to be here and to be part of today's, what I would say, a very meaningful ceremony. And we all know, we heard a lot from Dr. Sheikh just now. To make it very short, I must say that MIER is an independent think tank group and is a non-profit organization. We started from January 2nd, 1986. We've been focusing a lot on economics, financial, and also in the area of business. Today we have moved into a new milestone, I must say, that it's time that we moved into a collaborative mode. And today is my second day of representing MIER on this MOU and MOA. Yesterday was an MOU with the Asian Insurance Institute, and today is an MOA with MIER itself. Now, coming from here, going forward, what I would like to say is that the global economy in actual fact is kind of resilient and is holding on quite well, despite the kind of cautiousness underneath that. To start off with, if you look at the first half of this year, the global economy actually held on well with all the vulnerabilities from the global financial market that we went through. At one point of time, we were all thinking that the US would go into an emergency rate cut, which did not happen, and the markets on the whole kind of tapered off from this volatility. The other part is the geopolitical headwinds that we went through. So in that, the first half, in actual fact, the world economy held on well, while some were already talking about a recession coming into the second half. And if you look at the US economy per se, it actually did remarkably well in the first 2 quarters, supported very much by the domestic spending and also on the inventories itself. Euro is quite interesting in the sense that it's like water. It can be milky, it can be clear. We're not too sure where they're heading to. If you look at euro in the first quarter and the second quarter, the growth has been very stable. But having said that, there is still a bit of a risk that they may dip. If they may dip, much depends on what happens to Germany in particular. Now, coming to China, very interestingly, the first 2 quarter numbers are really good. Okay, they did well, and coming close to their targets of 5%. And very much supported by the manufacturing services side and also a bit on the trade. Malaysia in particular really performed extremely well, okay, with the second quarter GDP number. Actually, on average, it is slightly more than 5%. So there are strong possibilities that Malaysia could actually overshoot its 4 to 5% range this year itself. Now, moving forward into the second half of this year, the way I'm looking at it now, we have already gone to the 2 months. We have crossed 2 months in the second half. Now we're in the 3rd month. We are still seeing the global economy being very resilient. And one thing for sure, we are seeing major central banks have already started cutting interest rates. The latest was US, a 50 basis point cut. Many were looking at 25 basis point, but we were looking a bit more of a 50 basis point to start off with. And also inflation is cooling off quite well. And also what I'm seeing is that other economies are also holding up well, and they are compensating for the potential slower economic growth coming from US and from China itself. And if I look at US, what is the key factor that we should be focusing on in the second half of this year? It's going to be very much the labor market. Okay. We know that inflation is cooling off, but more so is now the labor market is kind of cooling off, stepping down a bit more faster. And that would mean that the consumption could also be stepping down. The second half indicators, these are the 2 key major indicators we'll be looking at. And in the case of euro, what's happening is that inflation is coming down, interest rates are coming down, so the real wages are holding up quite well. And the job market is still okay, kind of favorable there. And the challenge here is going to be Germany. If Germany does not dip, euro is kind of okay, but if they dip, then they could actually dip. The whole area could actually dip. So the trump card here I foresee is that it's going to be Germany. And China, very interestingly, second half, we still see that recovery can be a bit uneven. It's a balancing game between manufacturing and services. If the manufacturing is doing, indicators are now showing there's a slight uptick on the manufacturing, but at the same time the services is coming off. So that's a bit of a tricky situation here. Who is going to offset who here? And the other part of China is actually the consumer confidence. It's still kind of weak, largely because of the labor market and the negative wealth effect, because we noticed that the property sector is actually coming up. Property prices are coming off quite fast. So that is the big challenge here. We know that they are sitting on surplus funds. Government policies are there, government is trying to stimulate things and even cut rates and all. But the confidence level of spending is still not there to keep the momentum going. So we just hope that going forward with new policies, the confidence has to come back. The confidence will only come if they trust the policy. And now coming to Malaysia, I look at Malaysia's second half. There are about 6 key indicators that actually supporting the economic growth for this year, the second half of this year, and probably going into 2025 itself. First thing is that actually on the consumer spending, it's kind of very sustained, and I foresee the consumer spending, which takes up about 60% of the GDP, should continue to support the economic growth this year. Point number 1 is that labor market is kind of stable, it's coming off the unemployment levels here, and then the government benefits supporting, the salary adjustments coming into the picture, and more importantly, inflation is slowing down. It's a bit of cooling effect, despite the diesel subsidy and the various reforms that came into the picture. Inflation is still holding, coming off decently well. It's not going to, I don't foresee inflation spiking above 3.5%, though the target range is 2.8 to 3.5. At MIER, we are looking at a bit more of 3% kind of level. And if you look at the cost of funds, OPR is more likely to stay at about 3% kind of level. And very importantly is the positive sentiments coming from the steady economic growth. We are seeing a bit of spending patterns coming in. And the second part is on the private investment. This is really taking up a good shape here. For one thing I must say is that the approved investment from MIDA's FI, foreign investment here, okay, is really remarkable. The total approved investment first half is about 160 billion. And we can see it's coming from the DI, domestic investment, and also the FIs itself. Besides the manufacturing side, if you look at the investment segment, services is also playing up a very important role here. And what I noticed is that the ratio between the domestic and foreign investment is actually improving. It's about 53% on the domestic and 47% on FI. So this clearly tells us that we are not overly relying on foreign investment to drive this economy. It also tells me one thing on the roadmap going forward. If I look at the way the Madani economic framework is being placed out, potentially Malaysians should be seeing more exporters out there, okay, with the way the DI is moving now. Okay. As opposed to some point of time, quite a few years back, I felt that the FI was taking the leading role compared to the DI. Okay. Today, the ratio has changed. And with this kind of approval numbers coming in, we are looking at about easily 80,000 jobs just on this segment. One more on the gig economy and all other areas coming to the picture. And if you look at the private investment, 2 key areas I'll look at is manufacturing. One is on the domestic demand and the exports. And in fact, the MIDA survey, MIDA MIER Business Confidence Survey, which I'm going to go into the next slide, clearly shows that okay, the positive sentiments are there. And the other part is on the services side, we're looking at consumption, and that's coming from the consumer spending and also on the tourism side here. And the impact from all the national master plans these are things that the realized investments should be giving continuous positive impact going forward. The multiplier effect is going to be there, and likewise from the spillover effects. Now, the third part here, this is what the business confidence survey did. Our maiden survey between MIER and MIER we did in July. Now we have gone back to do in September, and from now on we'll be doing on a very monthly basis, as what Dr. CEO just mentioned. If you look at the survey itself, about 70% of them are very optimistic, not just what happened, but also going forward. And from the highlights of the survey of what happened in the month of July, most of them, about 70% of the domestic players and about 60% of the exporters are kind of looking at a very stable to high new orders. And in terms of delivery time, there was no major impact to it. And if you look at the companies, they basically maintain the local suppliers base. About 75% of them maintained. And if you look at the selling price, 70% maintained the selling price, 60% maintained the input price. Probably this explains why the producer price index has been coming off fairly decently. Inflation has not spiked up so much. Also, probably this could also explain lack of transfer pricing impact here. Now, if you look at the outlook going forward, the 3 months outlook at the month of July, we're looking at 75% of them are talking about telling us their outlook is either stable or better. And in terms of sales, 85% are saying the same story. New orders, you can see on the domestic side is 70%, export side is 60%. And if you look at employment, they're expecting an increase in employment, 80% of them. One very important point I would like to highlight here is on Malaysia's image. This is something you got to take note, is that more than 80% are saying Malaysia's image today is excellent. It's very favorable. And this could actually be another trumpet to MIER on the FDIs, which we look at the kind of flows of numbers coming in. And as a result of this kind of very favorable image of Malaysia, we are looking at 51% now planning to expand their business. So these are the basic findings that we have got from our survey here. And the point number 4 that would be supporting the economy is also on the export side. If you look at the export side, July numbers were fantastic. Okay? It is the fastest in 24 months in terms of annual change, and in terms of value, is the highest since October 2020. And we are looking at an export growth this time is about easily 5% kind of level, largely supported by technology and also on the resilience of our economic growth and trade. Intra-regional trade is also playing a very important role today. Now, besides that, stable commodity prices, the FTAs and the bilateral agreement, and one very important thing I'd like to highlight here is also the new markets that we are looking at. You must remember Malaysia is a trading nation, and we are always good to everyone. So for business purposes, as an exporting country, we need to have a lot of new markets. Either you go in bilateral or you go in multilateral kind of trade. So it is really, really important. And another very important point I'd like to highlight is on the reforms. There's humongous increase in confidence in terms of our reforms. First thing, there is already implementation capabilities. We have already seen quite a number of bold reforms that has taken place. Resulting from that, we are also seeing there's a lot of short and long-term benefits for the people and business. Now, as a result of these reforms, second half of this year, we are expecting the equity market to pick up. We are already seeing foreign inflows into the portfolio investment. All this while has been net outflow. Now we are seeing net inflows coming in. And that's largely because of these reforms coming into the picture, besides the stable economic growth. Bond markets is also on a positive trend. And resulting from these reforms, I foresee that our financial fiscal soundness should actually improve going forward. We should be able to potentially mitigate any kind of headwinds. Once the budget deficit level starts to come down more and more, we have more room to play around with the budget deficit and the debt sustainability level. Given this kind of trend, I would not be surprised next year we get a re-rating by the foreign rating agencies going upwards. And the last point I would like to highlight is on MIER. If you look at the Malaysian ringgit, initially this year, if you look at most economists, they were talking about 7 rate cuts by the Fed. At the end of the day, now we're looking at 1 to 2 rate cuts. And if you look at our point of view, we always have maintained like 1 to 2 rate cuts, not 7 rate cuts here. 25 basis point rate cuts has got it has got less meaningful impact compared to one big 50 basis point cut and another 50 basis point cut. Because you must remember the way the US pushed rates up was humongous. It was about 225 basis points, 250 basis points interest rate differential between the US Fed fund rate with ringgit, with our OPR. Now I'm looking at the drivers for MIER is going to be one, the narrowing of the interest rate differential. This year I'm looking at about easily 100 basis point cut. If there is a 100 basis point cut by the Fed at the end of the day, now that should see the interest rate differential coming off to 125, 150. Second thing that's supporting ringgit is actually the fiscal reforms, the inflows of FD, foreign investment, and the realization levels. We're looking at about 80% levels of realization of investment here. Then comes, we are on the radar screen of the portfolio investment, not just bonds. Today we are also talking about equities here. And the sustainable growth, stable politics, and if you ask me whether ringgit is overvalued, no, ringgit has been terribly undervalued for a long time. If you look at the nominal effective exchange rate and the real effective exchange rate, the fair value of ringgit should be 380, 390. But if I look at time series modeling and other different kind of modeling, it shows me the high end close to 420. So technically, ringgit should be coming back to 380, 390 on a MEER and a REER kind of levels. And in all aspects of things, there is always headwinds. Headwinds will always be there. One, the geopolitical. We can't run away from the geopolitical risk here. But my bigger concern is the Russia-Ukraine war, together with this whole geopolitical. What I foresee is that there's high risk there could be 2 separate trading blocks coming up going forward at the way things are happening now. And if that happens, now what's going to happen to the multilateral trade rules? Are we all going to follow the multilateral trade rules, or are we all going to follow our own rules? So the global trade rules can change because of this geopolitical tension and the Russia-Ukraine war. Now, other factors that we should all be concerned about is one, the climate change and environment, and another key thing is on the AI. Today, AI is being abused and also being used well. So AI is also generating a lot of misinformation and disinformation of things. Polarization, cost of living, and armed conflicts are the other factors that can affect us. Now, coming to my last slide here, if you look at the outlook of Malaysia's GDP, I'm looking at 5%, but I foresee that it can even cross 5% this year, and even going forward next year, we should be doing very well. And in terms of inflation, we're looking at a bit of 3%, but next year we should be coming off a bit more. Because the only impact left now we are waiting for is the RON 95 subsidy rationalization of that part here. Job markets are expected to improve. If you look at the ringgit average, the average this year is 455. Why is that so 455? That's because the first part of the year, the ringgit was quite weak, went up to 470 something, 480. So on average, so that has affected us. But going forward next year, I foresee average of 420. That would translate that this year ringgit could settle at 440 or even slightly stronger than that. But next year, around 410 should not be of a big issue here. Now, with that, I would like to end my entire presentation here. And first and foremost, I would like to end by taking this opportunity to express my earnest appreciation to both the teams, MIER and MIER. Because without the support and help, I don't think we would have made the inroad this far here. And with that, I would like to say thank you very much.